Welcome to Online Trading Campus and welcome to our OTC Futures course Module 3 Intermediate. Lesson 2 covers the whole spectrum of possible risk scenarios. I will start this lesson by highlighting various additional risk scenarios. Some of them are even beyond your control. However, if we are aware and understand these scenarios, we can further mitigate our risk. Part of this lesson is also to understand what a professional trader calls gap risk. You will learn the fundamental concepts on how to mitigate the risk of gaps in the futures market. And last but not least, I will spend some time explaining the terms circuit breaker and limit move. Let's start with the risk assessment. Number 1, trading sessions risk. A trading session is the primary trading hours for a given market. Different markets each have their own working hours. Trading during certain trading sessions and not being aware of specific market opening hours involve a greater risk. Yes, there are certain times a day that could potentially have higher risk for us. Higher risk of getting stopped out, higher dollar amount risk as far as where we place our stop losses, and higher volatility. The trading sessions risk also lead to the risk of gaps because of the different specific market opening hours, which I will discuss later on in this lesson. Number 2, liquidity risk. Liquidity is how easily a financial instrument can be bought or sold in the market and converted into realized profit. Market liquidity risk is the inability to easily open and exit a position for the pre-planned price. The most popular measure of liquidity is the bid-ask spread. A low or narrow bid-ask spread is said to be tight and tends to reflect a more liquid market. Or in other words, by not having enough liquidity, meaning there's nobody on the other side to take your trade. The important factor here is volume. Volume shows us how many trades have been taken place in the past. Liquidity really refers to what the volume was in the past, but more importantly, what the volume will be in the future when I want to place a trade. Consequently, I need someone on the other side of my trade so that my trade will get filled at the price I want it to get filled. That's what we really mean by liquidity. So think about this. When you open a position, long or short, or if you want to close a position, stop out or hit your target, don't you want enough liquidity to be able to get out at the price you want to get out at? Of course we do, absolutely. But if we don't have enough liquidity, we're going to get a price that we don't want to get when we get stopped out. That's called slippage. Number 3, volatility risk. Volatility represents how large financial instrument prices swing around the mean price. The risk lies in a significant increase in volatility in a market, or in other words, in the large swings far beyond, up or down, the mean price. As a result, the unexpected increased volatility might exceed your trading skill or psychological comfort zone. Number 4, black swan risk. Well, a black swan is actually an animal. But as it relates to the financial market, what we mean by a black swan event is it's really a market event that strays so far outside what is probable and is beyond normal expectations that is so rare that even the possibility that it might occur is unknown. And these events are also exceedingly difficult to forecast. And because they are difficult to forecast or understand when they are going to happen, it'll add risk to our trade or investment. Now do keep in mind, these black swan events, they could be various things out there. It could be, for example, the S&P 500 dropping 10% in one day. Okay, that's not likely. Is it possible? Of course it is, but it's not likely. Or what if corn rallies 5% in 2 hours? Again, not likely, but possible. So when we look at these black swan events, if we are in a corn long position and it does go up 5%, you are doing your happy dance. But if it drops down, that's when your stop loss order is going to kick in. But if it's going down that far, that fast, you are likely going to get some pretty severe slippage in the corn market. So how can we limit these risk factors? Number one, trading sessions risk. Here specifically, I want to address all daily income traders. Well, first of all, we want to know our low volume time as well as the high volume time for any specific market we trade. Why does the volume have anything to do with risk for a daily income trader? Let me explain. We do want to have good liquidity / volume when we trade. So by knowing where the low volume time and the high volume time is, this gives us the ability to not only get a better fill-in price, but the price that we want. And think about this. If we are going to get stopped out on a trade, wouldn't we want to get stopped out at the price we have already predetermined our risk amount to be? Not a worse price. So if we have low liquidity or low volume, what that means is we are putting our trade at risk. How to plot only the high volume time for any specific market we will cover specifically in module 4. Number 2, liquidity risk. For liquidity risk, please ensure there's adequate volume and a low bid-ask spread. So how can we quantify adequate? So it's important to trade markets that have good solid volume. Enough that can handle the contract size that you're trading. Otherwise, you are going to be at the mercy of the financial instrument that you are trading. You don't want that. So what's good liquidity? Alright, great question. I'm glad you asked. For daily income, we really want to focus on 80,000 contracts average per day or higher. That's a particularly good amount. Now, we can go as low as 40,000. So keep in mind, the very lowest point for a daily income trader is 40,000 contracts, average daily volume, preferably 80,000. Keep that in mind, okay? Preferably 80,000, but we can go as low as 40,000 contracts, average daily volume. That would be adequate. Bottom line, it's all about volume. Make sure you have enough volume. So if you're trading a particular financial instrument that's, let's say, has only 3,000 contracts average daily volume, that's just not enough. It's just not. But if we are trading something that has 80,000 contracts or more, 50, 70, 300,000, sure, no problem. That's plenty of liquidity. That's plenty of volume there. Now, if you are a weekly and monthly income trader, really 20,000 contracts average daily volume would be a great starting point. But we can go as low as 5,000 contracts per day. That's getting pretty low though. That's for longer term trading and investing, monthly, yearly income. And smaller contract size obviously. But if you really want to increase your chances of not only getting the fill price that you want and reducing this liquidity risk, it comes down to volume. So with volume, we get better fills. If there's smaller volume, you get slippage. One more thing though, know what the high volume tide or low volume tide is. Think about this way. Let's say you're going to the beach. Like all traders do, of course, right? You bring your laptop and you're trading on the beach there. And if you're there all day, you would notice there's a high tide and a low tide from the water. Low tide, the water is pushed out. High tide, the water comes up much closer to the beach there, covers more ground. So think of that when it relates to volume. We as traders want to know where that high tide is for low volume and that low tide. And that just gets back to knowing the time of the day when the market is most actively traded. So bottom line here, traders, please make sure you have enough volume. That will solve a lot of these risk problems here that we could come in contact with. In the next lesson, we will define some numbers to volume and spread so you have a guideline to stick to. Number 3, volatility risk. For volatility risk, trade only markets with real money you have experience in. Practice first in a demo and ask us your coaches before entering a new market. And understand how economic events, the news, can affect volatility and plan not to trade during those events. Financial futures are heavily impacted by interest rate announcements, monetary policy statements, and central bank press conferences. For commodity futures, you have to be aware of crop reports and inventory reports. You have to have rules around these events. In lesson 4 of module 3, we cover economic events. You want to make sure that you trade markets that have a volatility that you are comfortable with. Now, we do need a healthy amount of volatility. We need some volatility because we want profit potential. So we do want that. But it needs to be at a level that you're comfortable with. So for example, if we look at the volatility of the 5-year Treasury note futures compared to the 10-year Treasury note compared to the 30-year Treasury bond, the tick values are quite a bit different. Now, they might move price-wise about the same distance, but there's a big difference between a small profit or small loss move versus a big profit or big loss move. So by trading markets that have lower volatility, slower moving, lower tick values and so on, that gives us a more psychological comfort level. And as a beginner, you're able to trade it in a much better way. So focus on trading markets that either are less volatile or have smaller tick amounts, or a combination of both more appropriately. The next piece of recommendation is in particular for the daily income traders. Watch out for those specific market trading sessions, the time of the day you are trading. Remember, during the opening hours or the real volatile time period, that is where you're going to see volatility increase. So you understand the product that you're trading, know the time where it's most volatile, and also understand when the economic reports are going to be released. What time of day is there going to be a significant announcement, economic-wise or geopolitical, anything like that. We want to be aware of that so we can expect these larger volatility time periods. Number 4, black swan risk. So when we talk about black swan risk, we refer to a catastrophic or near catastrophic event. But it doesn't happen very often at all. But it does happen. So we as traders need to understand how to reduce this risk, even though it is very, very, very unlikely. You must be at least aware of it and at least understand that there's a risky scenario out there that we cannot control, okay? We can't control the occurrence, but there are always scenarios that we can control. So what can we control? That's what we want to focus on. Well, we can control our position sizing, we can control the markets we trade, the time we trade it, we can also control our stop losses, things like that. So those things are in our control. Understand that you can't control everything. And that's true, unfortunately. That's just life, not just trading, but life in general. We can't control everything. We plan the best we can ahead of time, plan for risk management, our position sizing, money management, our stop losses, and that type of stuff. And then we take a trade. Now, the other thing is, if we do have some big catastrophic event out there, well, by the time the market goes 50% against us, we are well out of that trade. That's what our stop losses are for. That's what our position sizing is for. So there are other things that we can do to help prevent this. Now, as a reminder, always use particularly good risk management. Stop losses, position size correctly, protect your account, protect your portfolio. So there are some tools out there that we can use to protect us from big catastrophic scenarios like this. And we have all the tools available. Now, what we don't want to do is just dwell on this every day and say, today is the day where we are going to have a black swan event. The market is going to collapse. Well, no, we don't want to have this pessimistic attitude every single day. We want to trade with confidence. We just want to be aware that the possibilities out there and protect ourselves the best that we can. But we don't want to trade scared. We want to trade with confidence. Trade our plan. We are not risk takers, but risk managers. Where does the gap risk come from? Very simple. Let's assume you hold a position, long or short, overnight or over the weekend. Then price opens far beyond your stop loss. As a result, the loss is greater than originally planned. We do not want this scenario. This could be a big loss for us. And believe me, you don't want this, especially when you are trading with leverage like we are in the futures market. Let me give you a few recommendations on how to avoid and reduce this risk. Well, first of all, we have to understand it's going to happen. There are going to be gaps. That's out of our control. We have to first understand that. Once we understand that, there are ways that we can actually reduce this risk. Let me show you a few examples. First, trade with a trend or at least anticipatory based on high quality, higher time frame demand or supply zones. Now think about this for a moment and you can do this yourself. Pull up any chart you want. Just identify what the trend is. Look for a period of an uptrend and a period of a downtrend. Price usually gaps with the trend direction. Sometimes it doesn't, but usually it does. Gap in the same direction of trend. So if you have a downtrend, it will usually gaps down. In other words, with the downtrend. Or if you have an uptrend, it will usually gap up with the uptrend. So by focusing on trading with that trend, that will help you reduce any potential gap risk that we have. Avoid also markets with high volatility that you are not trained to trade or that you have never traded before. Look whether those markets tend to gap and whether those markets have enough liquidity. Another thing to consider here. If there's a large economic event or some big world event that has been coming up and you know it's coming up, some big event that has been on the news and everyone's anticipating this, guess what? Expect volatility, one direction or the other. And when you have volatility, you are going to have gaps. So also consider not just holding it over the weekend, but if you know that there's a major event, worldwide or economic event that's been scheduled and announced and you know it's coming and everyone else knows it's coming, hands off. Just don't trade it for that day or those couple of days. Let the dust settle and then re-engage with your trading. That's fine. You're reducing your risk. If you do daily income and you're trading a tight zone, you might want to close your position before the weekend. Again, I don't want to generalize it because it depends on too many variables like what markets are you trading, are there major news announcements during the weekend, whether your position running in profit at the moment or is your position in red and close to getting stopped out. All this is something you require a bit of experience and every trade has to be evaluated individually. Last but not least, especially as a beginner, you should focus on markets that are open for almost 24 hours. Let me now show you the markets that have rather short opening times. The focus should be on markets that are open almost 24 hours. As a beginner, I can only recommend avoiding markets that have short opening times. They are more probable to have larger gaps at the opening. Here's a list of markets that have a short opening time. All timings presented are Eastern Standard Time. Cocoa Futures is open from 4:45 a.m. to 1:30 p.m. Sugar Futures is open from 3:30 a.m. to 1 p.m. DAX futures and German interest rate futures are open from 2 a.m. to 4 p.m. Cotton futures is open from 9 p.m. to 2:20 p.m. The meats, hog and cattle are open from 9:30 a.m. to 2:05 p.m. Coffee futures is open from 4:15 a.m. to 1:30 p.m. These are all markets with relatively short opening times, consequently rather prone to daily gaps. Now, could we trade these markets? Of course we can, and in many cases you're going to find some really great setups to trade in these markets, but you have to be aware of the risk. There are many traders out there that trade these markets, and they are particularly good at it. But they've developed their skill as a trader and they know how to manage the risks. They're aware of these gaps and they're going to happen. So they manage their position sizing, their trades, their risk management according to that. So in the beginning, if you have a lower skill level, focus on the markets that have closer to 24-hour trading. Each day at the market's close, the CME Group will create a reference price from where price is trading at 3 p.m. Central Time. Beware, this is not the 3:15 p.m. Central Time suspended session time. 3 p.m. Central Time coincides with the United States stock market closing time and puts the stock index futures contracts in alignment with the stock exchange's hours. From this reference price, a value of 7% of the contract value is derived and subtracted from it. This becomes the first circuit breaker for the stock index futures level 1. If price trades down 7% from the previous day's reference price, then the CME Group will halt trading for 15 minutes. Once the 15-minute halt is up, the market is free to rally or fall to level 2 of down 13%. If this occurs, the CME Group will again halt trading for 15 minutes. When trading resumes, the market can rally or fall even more. Level 3 is when the market is down 20% from its prior day's reference price. If the market trades to level 3, the CME Group will stop trading for the day in the stock index futures. The stock exchanges will also close at this point. The circuit breakers apply only during the regular trading hour session. The extended trading hour session will have separate daily circuit breakers. During the extended trading hour session, the market has a circuit breaker of up and down 5% from the prior day's reference price. During the extended trading hour session, the market is not allowed to trade beyond this 5% band until the next regular trading hour session starts. Circuit breakers for the stock index futures have been around since 1988 and have been modified over the years. As a trader, it is wise to always be aware of any specifications or rules that may cause the market you are trading to be suspended or halted during the day. While these are not frequent occurrences, we still need to be aware of these circuit breakers. Trading hours rarely change, but when they do, they too need to be noted, and each trader will have to adapt to these new hours. Knowing your market could mean the difference between getting an overnight margin call or holding a day trade for the weekend accidentally. Now let me explain the terms circuit breaker and limit move. The SEC, the Security and Exchange Commission, and CME Group Exchange joined together to implement daily price limits of the stock index futures to help eliminate exceptional equity price volatility. These rules are to take effect if the stock indices are down from the previous day's close more than a predefined amount. While some futures markets have limit up and limit down restrictions each day, the stock indices have circuit breakers. The difference between the two is that a limit move does not allow price to go any further for the current trading session. A limit move is also applicable to high volatility for both the upside and downside. A circuit breaker for the stock indices is only triggered to the downside and no restrictions to how high price can go on the upside. Circuit breakers will only halt trading temporarily, and once the market resumes trading, they can continue to fall more or rally. The table on the slide shows the current circuit breaker values. Level 1, 7%, level 2, 13%, level 3, 20%. The S&P futures contract will be the market to trigger these market-wide circuit breakers. The consensus was that the S&P represented a broader view of the market rather than just 30 stocks in the Dow Jones average. Each day, the CME Group will list what the daily circuit breakers are for these stock indices at this link: www.cmegroup.com/trading/equity index/price limit guide.html. Let's summarize the circuit breaker. These are predefined values which trigger an automatic stop when there is a certain move in any market on either direction. Possible scenarios after a circuit breaker: halting of trade in a market for a certain period, or halting of trade in a market for the entire trading day. In case of the first option, trading in the market is halted for a certain period to allow trading activity to cool down. If the volatility is still not controlled when trading resumes after a temporary halt, then the second option is invoked and trading is halted for the entire day. Let's summarize the limit move. The limit move acts as a circuit breaker and is the maximum amount of change that the price of a commodity futures contract is allowed to undergo in a single day. This amount gets its basis from the previous day's closing price. There are both upper limits and lower limits, which in any given market cannot exceed within a single trading day. Since each market has its own rules regarding limits, you have to visit the respective exchange website to see specific contract limits. So that's it for this lesson. In lesson 3 of module 3, we will define the criteria and requirements for our daily, weekly and monthly futures watchlist.